ratio analysis. First, we are going to learn what is ratio. Ratio analysis is the process of determining and interpreting numerical relationship based on financial statements. It is the technique of interpretation of financial statements with the help of accounting ratios derived from the balance sheet and profit or loss account. Classification of ratios. Analysis of short-term financial position or test of liquidity. Analysis of long-term financial position or test of solvency. And activity ratios, and the last one, profitability ratios. First, what is test of liquidity? The liquidity ratios are used to test the short-term solvency or liquidity position of the business. It enables to know whether short-term liabilities can be paid out of short-term assets. It is a valuable aid to management in checking the efficiency with which working capital is being employed. It is also of importance to shareholders and long-term creditors in determining to some extent the prospects of dividend and interest payment. Important ratios in test of liquidity. Current ratio, quick ratio, absolute liquidity ratio. Now current ratio. It is the most widely used of all analytical devices based on the balance sheet. It establishes relationship between total current assets and current liabilities. Formula of current ratio. Current ratio is equal to current assets divided by current ratio. Always current ideal ratio 2:1. High ratio indicates under trading and over capitalization. Low ratio indicates over trading and under capitalization. Now quick ratio. Quick ratio is also called as asset test ratio. It establishes relationship between liquid assets and liquid liabilities. It is a refinement to current ratio and second testing device for working capital. The formula of quick ratio is equal to quick assets divided by current liabilities. The quick ratio, always the ideal ratio is 1:1 ratio. Usually, a high asset test ratio is an indication that the firm is liquid and has ability to meet its current or liquid liabilities in time, and on the other hand, a low quick ratio represents that the firm's liquidity position is not good. Now, absolute liquidity ratio. This ratio establishes a relationship between absolute liquid assets to quick liabilities. Absolute liquid ratio is equal to absolute liquid assets divided by quick liabilities. In absolute liquid ratio, always the ratio is the ideal ratio 1:2. It means that if the ratio is 1:2 or more than this, the concern can be taken as liquid. If the ratio is less than the standard of 1:2, it means the concern is not liquid. Now, number 2. Test of solvency. Long-term solvency ratios denote the ability of the organization to repay the loan and interest. When an organization's assets are more than its liabilities is known as solvent organization. Solvency indicates the position of an enterprise where it is capable of meeting long-term obligations. Important ratios in test of solvency. Debt equity ratio, proprietary ratio, solvency ratio, fixed assets to net worth ratio, fixed assets ratio, debt servicing ratio, and dividend coverage ratio. Again, test of solvency ratios we will see. Debt equity ratio, proprietary ratio, solvency ratio, fixed assets to net worth ratio, fixed assets ratio, debt servicing ratio, dividend coverage ratio. Now, debt equity ratio. It is calculated to measure the relative claims of outsiders and the owners against the firm's asset. This ratio indicates the relationship between the outsiders' funds and the shareholder funds. The formula of debt equity ratio is equal to outsiders' funds divided by shareholder funds. In the debt equity ratio, always the ratio is 2:1. It means for every 2 shares there is 1 debt. If the debt is less than 2 times the equity, it means the creditors are relatively less and the financial structure is sound. Now, proprietary ratio or net worth ratio. It establishes relationship between the proprietors, funds or shareholder funds and the total assets. The formula of proprietary ratio or net worth ratio is equal to proprietary funds divided by total assets. In the proprietary or net worth ratio, always the ratio is 5:1. Higher the ratio, better the long-term solvency position of the company. Now, solvency ratio. It expresses the relationship between total assets and total liabilities of a business. This ratio is a small variant of equity ratio and can be simply calculated as 100 equity ratio because the solvency ratio is equal to total assets divided by total liabilities, whereas always in the problems the assets will be seen as liabilities. That's why this is also called 100 equity ratio. Again the formula, total assets divided by total liabilities. No standard ratio is fixed in this regard. Higher the solvency ratio, the stronger is its financial position and vice versa. Now, fixed assets to net worth. It is obtained by dividing the depreciated book value of fixed assets by the amount of proprietary funds. Fixed assets to net worth ratio is equal to net fixed assets divided by net worth. Again the formula, fixed assets to net worth ratio is equal to net fixed assets divided by net worth. In fixed assets to net worth, always the ratio is 0.75:1. A higher ratio, say 100%, means that there are no outside liabilities and all the funds employed are those of shareholders. Now, fixed assets ratio. It establishes the relationship between fixed assets and capital employed. In fixed assets ratio, the formula is fixed assets ratio is equal to fixed assets divided by capital employed. This ratio enables to know how fixed assets are financed, that is, by use of short-term funds or by long-term funds. This ratio should not be more than 1. Again, the formula is fixed assets ratio is equal to fixed assets divided by capital employed. Now, debt service ratio. This ratio is determined by dividing net profit by fixed interest charges. Net profit before deduction of and income tax divided by fixed interest charges. Again, the formula, net profit before deduction of interest and income tax divided by fixed interest charges. This ratio determined by dividing net profit by fixed interest charges. Debt service ratio is equal to net profit before deduction of interest and income tax whole divided by fixed interest charges. In this ratio, always the ideal ratio is 6 or 7 times. If the ratio is high, it means there is higher margin of a safety for the long-term lenders, and as such it is not difficult for the business to obtain further long-term funds and vice versa. Dividend cover ratio. It is the ratio between disposable profit and dividend. Disposable profit refers to profit left over after paying interest on long-term borrowing and income tax. Dividend cover ratio is equal to net profit after interest and tax divided by dividend declared. In this ratio, the profit left over after paying interest and long-term borrowing on income tax. So, the dividend cover ratio formula, dividend cover ratio is equal to net profit after interest and tax divided by dividend declared. This ratio indicates the ability of the business to maintain the dividend on shares in future. If this ratio is higher, it indicates that there is sufficient amount of retained profit. Activity ratio. Activity ratios indicate the performance of an organization. This indicates the effective utilization of the various assets of the organization. Most of the ratio falling under this category is based on turnover, and hence these ratios are called as turnover ratios. Important ratios in activity ratio: stock turnover ratio, debtors turnover ratio, creditors turnover ratio, working capital turnover ratio, fixed assets turnover ratio, current assets turnover ratio, total assets turnover ratio. Now we are going to see each of them. Stock turnover ratio. This ratio establishes the relationship between the cost of goods sold during the given period and the average stock holding during that period and indicates operational and marketing efficiency. Inventory turnover ratio is equal to cost of goods sold divided by average stock. Here, cost of goods sold is equal to sales minus gross profit plus opening stock plus purchases minus closing stock. Here, the cost of goods sold is equal to nothing but our trade account, because all debit side items we are adding and we are reducing the all credit side items. So, again the formula: stock turnover ratio, inventory turnover ratio and stock turnover ratio will be the same. Inventory turnover ratio is equal to cost of goods sold divided by average stock. Cost of goods sold is equal to sales minus gross profit, opening stock plus purchases minus closing stock. Now, what is average stock? Opening stock plus closing stock divided by 2. Is it called average stock? In case there is no closing stock in the problem, the opening stock as your average stock. Debtors turnover ratio. This ratio explains the relationship of net credit sales of a firm to its book debts, indicating the rate at which cash is generated by turnover of receivables or debtors. Debtors turnover ratio is equal to net credit sales divided by average debtors. Net credit sales is equal to total sales minus credit sales. Average debtors is equal to opening balance plus closing balance divided by 2. In some case, there is no closing balance and opening balance of the debtors. The actual debtors is called as average debtors. Creditors turnover ratio. This ratio indicates the number of times the creditors are paid in the year. Creditors turnover ratio is equal to net credit purchases by average creditors. Net credit purchases is equal to total purchases minus credit purchases. Average creditors is equal to opening balance of the creditors plus closing balance of the creditors divided by 2. Average payment period. Number of working days divided by creditors turnover ratio. Working capital turnover ratio. This ratio indicates the number of times the working capital is turned over in the course of the year. Measures efficiency in working capital usage. Working capital turnover ratio is equal to cost of sales divided by average working capital. Average working capital is equal to opening capital plus closing working capital divided by 2. Fixed assets turnover ratio. This ratio establishes a relationship between fixed assets and sales. So fixed assets turnover ratio is equal to net sales divided by fixed assets. Here the ideal ratio of fixed assets turnover ratio is 5. A high ratio indicates better utilization of fixed assets, whereas a low ratio indicates underutilization of fixed assets. Total assets turnover ratio. This ratio establishes a relationship between total assets and sales. This ratio enables to know the efficient utilization of total assets of a business. Total assets turnover ratio is equal to net sales divided by total assets. High ratio indicates efficient utilization and ratio less than 2 indicates underutilization. Profitability ratio. Profitability ratios indicates the profit earning capacity of business. Profitability ratios are calculated either in relation to sale or in relation to investment. Profitability ratios can be classified into 4 categories: general profitability ratios, overall profitability ratios. General profitability ratios: gross profit ratio, net profit ratio, operating profit ratio, expense ratio. Gross profit ratio. It expresses the relationship of gross profit to net sales and it expressed in terms of percentage. This ratio is a tool that indicates the degree to which selling price of goods per unit may decline without resulting in losses. Gross profit ratio is equal to gross profit divided by net sales into 100. A low gross profit ratio may indicate unfavorable purchasing, then instability of management to develop sales value, thereby making it impossible to buy goods in large value. Net profit ratio. It expresses the relationship between net profit after taxes to sales. Measure of overall profitability useful to properties as it gives an idea of the efficiency as well as profitability of the business to a limited extent. Net profit ratio is equal to net profit after tax divided by net sales into 100. Operating ratio. This ratio establishes a relationship between cost of goods sold plus other operating expenses and net sales. This ratio is calculated mainly to ascertain the operational efficiency of the management in their business operations. Operating ratio is equal to cost of goods sold plus operating expenses divided by net sales. Operating profit ratio. This ratio establishes the relationship between operation profit and net sales. Operating profit ratio is equal to operating profit divided by net sales into 100. Operating profit ratio is equal to 100 minus operating ratio. Expenses ratio. Cost of goods sold is equal to cost of goods sold by net sales into 100. Administrative and office expenses ratio. Net sales, office and administrative expenses, net sales, selling and distribution expenses divided by 100. Non-operating expenses ratio. Net sales, non-operating expenses divided by net sales into 100. Test of overall profitability. Return on shareholders' investment or net worth ratio. Return on equity capital. Return on capital employed. Dividend yield ratio, price covering ratio, dividend payout ratio, earning per share. Thank you.